want an exposure to a market or an asset.
Everything they need in one place.
The world's foremost authority on
Individuals, advisors and institutions.
For this episode of Fund Managers Favorites, I'm joined by Henry Dixon. He focuses on investing in overlooked, unloved, and undervalued stocks, and this strategy has paid off well in the past. In fact, in 2012, his fund returned 24% to investors, which was way better than its peers. So he's joining me now to talk about his top picks and his overall investment strategy. So Henry, thanks for coming in. Now, let's talk specifically about your strategy. Now, you focus on these undervalued areas. Are there certain kinds of stocks that you look at?
Yeah, I think I could sort of sum up, generically the type of stock I'm interested in. I'm interested in stocks that you would absolutely have no chance of replicating for the current price on the screen. And the overlay I would add to that also is I demand that these stocks be cash generative. And what you tend to find, therefore, is that weaker competitors will exit the industry, the strong get stronger, and the business comes back and makes more money than it did in the last cycle.
Okay, now your top three picks that you've brought today, we have Carnival in the large cap area, Bank of Georgia, mid cap FTSE 250, and H&T Group, a small cap company. So let's go over each of these stocks and why you like them. Let's start with Carnival. Not everyone's going around saying that they like this company right now. Why do you like it?
Yeah, I think there are two things. I think as I make every investment, I always like to sort of test the downside thesis, and I think we are just sort of approaching the time when Costa Concordia is still in people's minds, but obviously slightly over a year ago now. But we're in a situation whereby I thought the most interesting data point that we got out of the incident was the insured payout that Carnival received for Costa Concordia. And as I transpose that value across its entire fleet, we're in a situation whereby the insured value of the fleet is slightly above the current value of the company. So I think that gives us a great deal of confidence in the downside. With regards to the upside, I think we've got a situation whereby so we see a slightly better picture in the US with regards to the consumer turning, with house prices are picking up, and that's very relevant. And then also a key cost in that profit and loss account will be the oil price. And if the oil price is starting to fall, be it because of better supply, falling demand in the US, then that will also be incredibly positive. And the other area as well is it's all very well these earnings picking up, but if it's not going to be returned to shareholders, then to some extent it's a little disappointing. But the other area that I'm also very optimistic is that over the last 10 years, the company has been guilty of building too many ships, in my opinion. They are, however, reining back on that ambition of building new ships. That means any cash that is generated has an incredibly good chance of being returned to shareholders in the form of dividend or buyback. Okay,
moving on to your mid-cap pick, Bank of Georgia Holdings. I did not even realize that this was in the FTSE 250. Tell me how you found it and what do you like about it?
Well, you definitely won't be alone in realising it's not in the FTSE 250. I think this would obviously fall into the overlooked area. It's very poorly covered by the street, and I absolutely adore finding situations which are poorly understood, poorly covered, because it does allow me as a stock picker to be really able to express myself with regards to value. With regards to the value, this company is the cheapest share in the FTSE 250 on price earnings, which would be a very sort of relevant metric that many people would use, but it's trading on about 5 times earnings. As I move to the balance sheet as well, it's trading well below book value. It's trading at about 0.9 of its book value. Now, of course, we can find banks in the Western world below book value, but typically they're loss-making or making exceptionally poor returns on equity. But in this instance, Bank of Georgia is generating a return on equity in excess of 20%. So it looks a standout value on the profit and loss and incredibly good value on the balance sheet as well.
And it's a well-run company as well?
Yeah, fantastic well-run. I think we can take a lot of comfort from how it coped with the downturn in 2008. The business remained profitable at the operating level. It didn't require state aid, and I think that gives us a huge amount of confidence in the ability of this business to weather tough times.
Okay, now moving on to your third top pick in the small cap area, H&T Group, a pawnbroking business. Tell me a bit about why you like this company.
Yeah, I think it's the first reason I think would definitely be valuation. Again, I see a very undemanding sort of earnings-led valuation of approximately 8 times, which puts on a really healthy discount to the market. Also, with regards to its balance sheet, this is a business that specialises in putting secured loans against sort of personal items, be it a watch or a clock or a gold chain, for example. And the way it holds these items as they are traded into this business is incredibly conservative. Typically, they hold them at about sort of 50, 60p in the pound relative to their true value. So to be buying this business in and around book value, when I believe the asset value is incredibly conservatively stated, I think is really exciting. So I see great balance sheet value and very good earnings-led value as well.
Now, moving on to the key risks for each of these companies, let's go over one key risk per company, and let's start with Carnival.
Yeah, I think an obvious key risk would be a spike in the oil price. All I could do to put people at ease with that is that I see that net speculative longs in the oil price are now at a 25-year high, so I'd say political risk is in the price, not out of the price, but that would definitely be a key risk.
Okay, and for Bank of Georgia, what would you say the key risk is there?
Yeah, I mean, I think it's a very generic term, but obviously it would be political risk. But I think it's worth pointing out there's political risk everywhere in the world. BP found that out to their cost, probably in the Gulf of Mexico. And yes, as you know, Georgia, its proximity to certain areas in the world means that people will probably tar it with a slight sort of political risk brush. All I can say to offset that is the astonishing starting valuation relative to peers on emerging market bank peers. It looks incredibly cheap, and as I say, I draw a huge amount of confidence from how it handled itself in an incredibly difficult period in the financial crisis.
And what about H&T?
I think probably there, I would probably say the biggest risk to H&T would be quite a sharp fall in the gold price. Historically, this company has done quite well from people trading in their gold products and monetizing them for cash. So I think that would probably be the key risk that I'd highlight. If the gold price was to fall by, let's say, over 10%, then I think that would reflect badly on H&T.
So people might stop trading in their gold.
Absolutely.
Okay. Thank you very much for coming in today.
No problem.
That was Henry Dixon from Matterly Asset Management, and I'm Alana Petrov. Thank you very much for watching Morningstar.